Hello, good afternoon. Thank you for joining our first webinar for securities borrowing and lending and short selling. So we opted to provide a refresher on securities borrowing and lending because it's integral to the short selling processes. So first we'll be discussing the fundamentals of SBL. So its features and how it works in the Philippine stock market, and also the risks involved and the relevant rules and guidelines that were issued by several regulators actually. So there's the BIR, the SEC, the PSE, and the CMIC. And after having a better grasp of what securities borrowing and lending is, we can now go into short selling. So I'll be discussing and walking you through the short selling process, as well as the newly issued short selling guidelines, which we released last June. So without further ado, we can start with securities borrowing and lending. So what is securities borrowing and lending? So it's like your typical loan transaction. When you go to a bank, you would want to borrow cash, but instead of getting cash, the borrower would then get securities. So like in a typical loan transaction also, the borrower would also have to deliver collateral to the lender. So these collateral can be in the form of cash, equity securities, or government securities. So just a few SBL features or fundamentals in the Philippine market. So securities borrowing and lending is subject to a maximum period of 2 years. So each SBL transaction that you will execute is only subject to a maximum of 2-year borrowing period. However, the borrower can return the shares at any time within the limit. It's also important to note that SBL transactions are tax exempt, provided that the borrowing and lending arrangement is registered with the BIR. So the particular SBL transaction that will be tax exempt is actually the transfer of shares from the lender to the borrower. And when the borrower wishes to return the shares already to the lender, that particular leg of the transaction is also tax exempt. However, if the shares are not returned within the 2-year borrowing period, the loan will be considered as a sale. So since the actual borrowing and return did not incur any stock transaction taxes, this one, if it's not returned within the 2-year period, it will be considered as a sale and will be subject to capital gains tax. So under the train law, I think that capital gains tax is a flat fee of 15%. Another feature of the SBL here in the Philippines, so of course, as with any loan transactions, there are fees involved. So lenders usually charge a lending fee. And then for you investors who wish to participate as borrowers, you may get in touch with your broker. And for this additional service of facilitating the borrowing transactions, brokers may charge also a service fee for that. Then another important feature is that the ownership of the shares is transferred. So when the securities are on loan, the legal ownership is transferred from the lender to the borrower only up to the borrowing period. So only until the duration of the loan. So in an SBL transaction, the borrower will then be the one who will receive the economic benefits from the loan securities. These would be your dividends, your whether it's cash or stock dividends or voting rights or rights to acquire more shares. So being the legal owner now, the borrower will be the ones who will receive it. But at the end of the borrowing period, the borrower has to remit the shares to the lender, including all the economic benefits that that he received. So this would include the dividends or the stock dividends that the borrower has received. Ownership is also regained by the lender at the end of the borrowing period upon the return of the shares, and likewise, the collateral received by the lender is returned to the borrower. So who are our potential borrowers and lenders? So the potential borrowers would be your hedge funds, proprietary traders, securities firms or your brokerage firms, mutual funds, and investors like you. For the lending side, these would normally be those long-term investors or those with a passive portfolio, such as pension funds, insurance firms, retail funds, securities firms, and banks. As I previously mentioned, the agreement between the borrower and the lender has to be registered with the BIR. So this particular agreement is what we call the Master Securities Lending Agreement. So this agreement outlines the relationship and the responsibilities between the borrower and the lender. So what are the details that are contained inside the Master Securities Lending Agreement? These would be your collateral or the types of collateral that can be accepted by the lender. So as mentioned also previously, these would be cash and government securities and equity securities. For cash and government securities, the required or the minimum required collateral rate is 102% of the market value of the securities on loan. For equity securities, on the other hand, the required collateral rate is 105% of the market value of the securities on loan. This, however, can differ from, depending on the parties, it can even go higher than that. Um, Likewise, the if and how the collateral can be reinvested must also be stated in the MSLA. But it's up to the parties involved if they want this particular reinvestment in place. Of course, the lending fees would have to be included in the MSLA as well as the calculation method. Under the MSLA, the borrower must also state the purpose for the loan. So what will be the borrowed securities used for? For example, it can be used for settlement purposes, for strategies, trading strategies like short selling, on lending, financing, among others. It will also be stipulated in the Master Securities Lending Agreement whether the lender is acting for itself or on behalf of its clients. So when the lender is acting for itself, for example, your stock brokerage firm is your direct lender. So the brokerage firm in that scenario can only lend their proprietary shares or those shares that are owned by the stock brokerage firm itself. But when the lender, that particular stockbroker, decides to lend out the shares of its clients, another separate agreement would have to be executed, which is called the Securities Lending Authorization Agreement, which is an agreement between the principal, the lender, and the beneficial owner of the shares. In which case, that particular lender would have to apply and register as a lending agent. So later on, I'll be discussing what the SLAA is in the succeeding slides. Lastly, the term of the agreement is also included in the MSLA. So this would be the length or duration of the contract and other termination clauses that would be agreed upon by the parties involved. So for stock brokerage firms who are registered as a lending agent or those who are or those who can lend their clients shares, they would have to execute a securities lending authorization agreement with their client. So this governs the relationship between the owner of the securities or the beneficial owner of the securities and the lending agent. In our example's case, these would be your stockbroker. So what is the relationship between the lender and the lending agent? So the lending agent is the one who actually finds borrowers for the pool of lenders that they have. So now let's talk about what's included in the Securities Lending Authorization Agreement. So it outlines the authority and responsibilities of the lending agent to the beneficial owner of the shares. Second, the fees or the amount payable to the lending agent for the services he rendered. And lastly, the approved list of borrowers identified by the lender. So let me just show you the typical transaction flow, the SBL transaction flow. So we will start off with the execution and registration of the MSLA. So once it's already been registered with the BIR, the borrower can now initiate the borrowing. So we will call up the lender and ask for, say, 100 shares of XYZ stock. So upon the agreement within the borrower and the lender, if the lender confirms that the shares are available for lending, then the borrower would have to deliver the collateral to the lender, and the lender would in turn deliver the securities that's desired to be borrowed by the borrower. The collateral will then be managed by the lender, or as the parties agree, they can actually hire a third-party collateral manager for this. When the borrower would want to return the shares already, so he no longer needs the loan securities, so the borrower returns the securities to the lender, and the lender would in turn return the collateral to the borrower. So why do people engage in SBL? So first, this is to meet settlement obligations. As we know in trading, we have to deliver our securities at T+3 or 3 days after we executed a transaction. But there are times when there's a risk that the delivery of the securities cannot happen within those 3 days. That's why the SBL market is tapped. This is to ensure that the transaction, that particular transaction, will not fail. Second, it's to support trading strategies such as short selling, which I will elaborate on later on. And lastly, it is to earn money from lending. So there are several long-term investors who are just in a buy and hold strategy. So they can actually earn extra income from the lending fee that they will generate. As with any other transaction, there are also risks in SBL, but these risks can be managed. So first, we will talk about counterparty risk. So these would be the risk that the lender will not be able to deliver the securities that the borrower wants to borrow. And on the other side of the fence, the borrower may have insufficient collateral or does not return the shares that's being recalled by the lender, or defaults on his contractual obligations. So how do we mitigate these risks? So first, you must really get to know your counterparty before you enter into any other arrangement with him. And it would also help if you would diversify your universe of borrowers and lenders. The second risk that we'd be dealing with in SBL transactions would be collateral and reinvestment risk. So there's a risk that the non-cash collateral provided by the borrower to the lender are not liquid. So in the cases of defaults, these collateral cannot be converted to cash as easily. Or if it's in the case of cash collateral, if it's put into investments, which somehow um, got a lower market value because the investment failed, so the value of the collateral would be much lower than what it was when it was first given by the borrower. How do we control this risk? So there's daily mark-to-market for non-cash collateral. And also, before you reinvest the collateral, you must conduct proper investment research or set reinvestment guidelines and limits. Lastly, there's also operational risk or administrative risks. So This deals with the monitoring of corporate actions or monitoring of the marking to market activity of the collateral and or failures or delays in the delivery of the shares to be lent. There are several things that the parties can do to control this risk. So first, they can have best practice procedures and guidelines, as well as a robust SBL system for monitoring and reporting. So to know more about securities borrowing and lending, so the governing rules and guidelines, documentary requirements, and reporting requirements that I've mentioned are all on the PSE website. So most of these are already templated, so you can check to know more about the SBL. It's located on the left panel under products and services. So just click on securities borrowing and lending. So with that, with a better understanding on how the SBL process works, we can now go into short selling. So, but first, you must know that there's two points of view. Normally, there's two points of view in the market. So there's the long position and the short position. So what happens when we are trading right now? We're in the long position, or we have an optimistic and bullish point of view because we buy a stock in hopes that the price of this stock that we bought would appreciate in the future. So there's an expectation of a price increase. So the strategy that we use is we buy now and sell later. But in short selling, you take on a short position or a short point of view. So this is more opportunistic and bearish. So instead of expecting the prices of the stock to increase, you expect the price of a particular stock to decline. So it's an inverse strategy. So you want to sell now or buy later. So this explains what short selling is. So it's a concept that it's any sale of a security that the seller does not own, but will be settled by the delivery of borrowed securities. So here we can see the importance of of securities borrowing and lending. So you must first have a borrowing in place before you can actually short sell. So just to illustrate, it's a reverse transaction. So you sell first through borrowed stocks and buy later to return the stocks that you borrowed. So just to show you, in a regular transaction, the investor would buy the security and then sell it a few days or weeks after in hopes that the price would increase and gain from that. In the short selling transaction, the investor should borrow the securities first and then sell it, and the shares would be settled through the borrowed stock, and then buy back the securities after a few days or weeks to return it to the lender. So this one, you hope to buy the securities at a lower price than what you sold it for. So to illustrate short selling as a strategy, say for example, the investor expects the price of stock XYZ to decline in the future. So what he did was he borrowed 10,000 XYZ shares. So the shares were delivered to him by the lender and he delivers the collateral. The current price of those XYZ shares that he borrowed was 10 pesos. So he posted the XYZ shares as a short sell at 10 pesos. After 3 weeks, the price of XYZ drops to 6 pesos. So in 3 weeks' time, the investor buys back the XYZ shares that he borrowed at 6 pesos. So did the investor make a profit? Yes, he did. So there's a price difference between the amount that he sold it for, which is at 10 pesos, and the amount that he bought it back for, which is at 6 pesos. So the investor made 4 pesos per share, or 40,000 pesos for the 10,000 shares that he borrowed. So after buying back the securities, the investor then closes his short position and returns the shares to the lender. So why do we do short selling? So it's a trading strategy which can be used to benefit from an expected future decline in price. So as you can see in our example earlier, the investor expects the price of XYZ shares to decline 3 weeks after. That's why he wanted to sell it now at 10 pesos. Second, it's also to hedge the risk of a long position in a security by taking on a short position in a related security. So to illustrate, say an investor holds shares in an energy stock A. So hedging is like insurance. So it's to protect you against volatility and risk. So to protect his portfolio in energy stock A, the investor decides to borrow energy stock B and short sell it. So the fact that he's short selling energy stock B is what we call hedging already. So it offsets the potential losses from price decreases in stock A. This is under an assumption that both uh, the prices of energy stock A and energy stock B are moving in the same direction. So short selling in the Philippine market. So it's not a new concept because short selling is allowed in many markets across the globe, including in our ASEAN peers. So short selling is allowed in Singapore, Malaysia, and Thailand. So in the Philippines, so we just recently released our guidelines last June 22, 2018. What does short selling mean for the Philippine market? So for us, it will support the development of the SBL program since, as mentioned earlier, SBL is at the core of short selling because you can't actually short sell without engaging in an SBL transaction. Second, it will generate more activity, trading activity and improve liquidity. So especially in the bear market. So it's the short sellers who would provide the additional liquidity because they take opportunities and price declines. And then on the other side, if you're a long-term investor who just typically just holds on to the shares, um, they can actually lend these shares to short sellers, and then which would in turn generate liquidity. Third, it will unlock more investment products. So short selling is actually needed for us to be able to introduce other hedging instruments such as derivatives. And lastly, it will promote efficient price discovery. So as I mentioned earlier, if you remember the long position and the short position. So right now, what's happening in the market is just the long position. So having short selling in place would enable investors to communicate the other side or a contrarian point of view. So in effect, it enables better valuation of the shares and mitigates price bubbles. Since we're just introducing short selling, so it's crafted to ensure that the short selling transactions are transparent and monitored effectively. So we put in place three salient points for the short selling guidelines that we released here in the Philippine Stock Exchange. So first, not all listed securities can be short sold, and there's a limit as to how much can be shorted. Second, investors must engage in SBL transactions prior to short selling because all short selling transactions must be covered. And lastly, investors cannot just short sell at any price they want. So I'll be discussing each of these features in more detail. As mentioned, they're only eligible securities for short selling. So we wanted to have the most liquid and most active stocks at the Philippine stock market to be the eligible securities for short selling, and these would be all the members of the PSEI. ETFs are likewise included as an eligible securities because it represents the members, all the members of the index. So to be taking on a more conservative stance, we wanted to put in place a maintaining short interest ratio, which is at 10% of the outstanding shares of each of these securities. So what does short interest ratio mean? So short interest is the number of shares short sold which have not yet been covered. So the short sellers are only allowed 10% of the outstanding shares uh, to be shorted. So who can short sell? So I know I've been repeating this a lot of times, but the investors would need to have the necessary borrowing arrangement in place prior to short selling, because naked short selling is not allowed. So the MSLA must be registered with the BIR, and it should be submitted to your broker if you want to conduct short selling activity. At what price should short selling be? So I've already discussed earlier that short selling opportunities are in a bear market, at a declining market. So to mitigate the steep declines in prices, short selling transactions are subject to an uptick rule. So this is actually a requirement by the Securities Regulation Code. So what is an uptick rule? Or all short selling orders must be at a price higher than the last sale price, or at the last sale price only if that price is above the next preceding sale price. So for the second item, um, here is an example. So for example, the last traded price is 1 peso. You can only short sell at 1 peso if the sale price prior to the last traded price is lower than the last traded price. So in this example, at 10:01 a.m., the price of a particular stock is 99 centavos. And then at 10:02, the last traded price was 1 peso. So if the investor would want to short sell, they can post the price at 1 peso, since it still complies with the uptick rule. But you investors don't need to worry about this, because the uptick rule is actually embedded in the trading system. So the trading system is the one who automatically checks if the short selling transaction is actually compliant to the uptick rule. Similar to SBL, there are also risks in short selling. So first is price risk. So not all expectations can come true. So maybe the investor's desired price will not happen. So could be that the share price that he short sold did not decline as expected. So in relation to that, there's what we call the short squeeze. So positive events may drive up stock prices rapidly, and the rapid increase in stock prices will force these investors to get out of their short positions, um, which are usually at a loss. So they're actually struggling to buy the share of stock to cover their short sell. With this high demand, it may be difficult to cover the shares, because the supply can be limited, because some of the sellers would want to have a buy and hold strategy since the price is increasing. So the supply can be limited for the short sellers, and or their expected gains from short selling will not happen. So what are our key takeaways in this webinar? SBL and short selling are integral parts of a robust stock market, as it provides our investors with more options and flexibilities with their trading strategies. Finally, having both products in place enhances the competitiveness of the Philippine market and supports the development of new products. So thank you for listening. And if you wish to know more about short selling and SBL, you can contact your local broker, and they can help you facilitate the borrowing and lending arrangements.